Hey everybody, Cody Schaaf here, Nebraska Realty, representing Richland Homes and Pinecrest Homes. Today, we brought in Mark Krings from Union Bank and Trust, who works with a number of builders around town and communicates with them and utilizes construction financing, which in the new construction market, we see it quite a bit. So I thought I'd bring in Mark and we just do a little Q&A about what does the construction financing look like from I'm gonna use construction financing to I've got a key and I'm moving in.
A construction loan really differs from a turnkey ready home or loan because obviously you're building the project from the ground up. So construction financing, we offer financing on the builder side, which would be pre-sold homes, spec homes, and then also consumer carried financing, which means they're still building a house, but they're carrying the financing as opposed to the builder. Typically, we will finance 80% of an appraised value.
So with 80% of appraised value, if you don't have a house to appraise, how do you get that 80%?
Yep, good question. So we will, anytime we start a project, either with a builder or with a consumer, we collect a building contract, the final plans and specs for the home to be built, the itemized budget, and then the lot of where the dwelling is going to be built at, and we submit that documentation to the appraiser, and then they are able to do an appraisal that is based on or pending completion. So they will do an appraisal based on the work to be done according to the documentation that they receive. And then we ask that the consumer has the financial resources or the builder to make up the remaining 20%, whatever amount of that is needed. And then a construction loan is a draw note. So on a draw note, you only pay interest on the amount of money that is advanced against the loan.
So I get a $100,000 loan. I have a $20,000 lot. Boy, wouldn't that be great?
Oh, that'd be...
So I get a $20,000 lot.
Certainly a different looking budget, but...
Yeah, a $20,000 lot, and I'm only paying interest on that $20,000.
Correct.
Okay.
As soon as the closing takes place to obtain that lot, then you're paying interest on the $20,000. And then most construction loans have draws on a monthly basis. So the following month, if you have your draw for the dirt work, foundation, footings, then that draw, let's say that's $20,000 also. So then when that statement cycle cuts, you'll be paying interest on the $40,000 that is outstanding at that point in time.
Okay, so then I'm doing a monthly draw at $20,000 for the lot, another $20,000 for the groundwork, the foundation, the footings, all that sort of thing. What if the concrete company isn't done yet and when that draw comes due?
So a lot of the builders will kind of collect them all within unison. So it doesn't have to be on an exact day of each month. If they know that, hey, we're 2 days away from the concrete being done, and then I'll have the invoice within 3 days, they can hold on to that draw and include that concrete invoice in the draw. Or if it's going to be a week or 10 days more, then they can just elect to wait until next month for that draw. There is the flexibility to do a draw as needed, if you will, but most construction loans have an allowance of 12 draws for the life of the construction loan. So to do a onesie, twosie, kind of like a one-off draw of, hey, pay this invoice, that flexibility is there, but it's not common because to get the most out of your 12 draws, you want to have multiple invoices or do it on a monthly basis. Or if you say, hey, I have 6 invoices, or it's the 15th of the month, or I hit 100,000, whatever it may be, they can do it based on what works best for them and the company that they're working with.
So can I, as a consumer, set that draw style up how I want to do it between me and my builder, or is that done by you guys?
That's a conversation that I would recommend you have with your builder prior to starting. We don't necessarily police the draws when they come in. Now, when I receive a draw, I'll look through it. First thing, I open it up and I make sure that the addresses on the invoices match the job site address.
That's a good idea.
For where the work is supposed to be done. And then I'll scrub it against the budget that was submitted initially. And then I'll send it on to our processor and say, I approve this draw, please, send it for payment. And when I do that, that means that the processor reaches out to the title company that is involved to get a verbal update to make sure there's no liens against the existing property. Once the title company says no liens, then we move the money from the construction draw or draw note, whether it's in the builder's name or the consumer's name, pay the title company, and then the title company cuts the checks according to how it was itemized on the draw sheet. And it's ran through the title company because then they also collect lien releases saying that the subs and the builders in general have been paid for the work that they've done on the property.
So I have an account with $100,000 in it that is set aside at the bank, and then you send that money to the title company to pay out the invoices.
Correct. Yep. It's not an account with the money in it, but it's a loan that's able to be drawn against.
Okay. So I have a loan that's able to be drawn against. I'm not collecting fees or interest against the total amount, just the amount that has been paid out for invoices to different vendors.
Correct. Yep.
Okay.
You pay interest on the money as you use the money.
I'm starting to finish up my house and getting ready to move in. What does that process look like?
Yep. So it's very important to be in communication about the last 60 to 90 days of the project completion for many reasons. From the builder aspect, they want to make sure they get everything wrapped up. They want to make sure that they're completing it, getting paid for the work, and that all final draws are paid. And then they sign the builder affidavit. And from the consumer side, that is when you can reach out to your permanent financing, your mortgage lender, and say, hey, we're getting close to construction completion. We're going to be working on the occupancy permit. And then once about 60 to 90 days out, they can also typically lock in a permanent financing interest rate. So then that's locked in. They're working on the file. And then as it gets closer, probably a month out, they set a closing time that they then take possession of the home, and the consumer or whoever's doing the permanent financing pays off my construction loan. And then you have your 30-year permanent loan with a fixed interest rate.
What happens? I have $100,000. You know where I'm going with this? $100,000, and I spend $200,000.
Well, that's so. I mean, obviously, projects coming in over budget happens, but that's why we scrub it against the budget that we initially received. Okay. And if it's over that budget amount, depending how much, if it's over by $100. We'll make note of it, but we probably won't reach out. If it's over by $1,000 or more, we'll reach out and say, hey, Cody, you went over budget on your carpet, on your flooring by $1,000. Is that something that you are going to pay out of pocket as you go, or do you think you'll be able to save another $1,000 somewhere else to try to manage that project to stay in there? But if somebody's going to be that much over budget, up to 100%, there's going to need to be some cash injections along the way, because even if the project goes over budget, we have a limit of 80% of the appraised value. And that's for multiple reasons. I mean, mainly it protects us and the consumer, but also when you get to permanent financing, to my knowledge, if it's under 80% LTV, then you don't have to pay the permanent mortgage insurance, which saves consumers in the end. So it's kind of built in there to be at the 80% methodically for multiple different reasons.
So 100% was a terrible example of being over, is that what you're telling me?
There's multiple checks and balances in place to try to keep the project on time and on budget.
Yeah. And I'm sure you have lots of great builders that do this over and over and over again, and it's a very streamlined process.
That's the great thing about working with the builders. They know what to expect. They have experience in doing it, so they know how to send it over. They know what to expect. They know what the communication looks like. They know the draw turnaround expectancy time.
Well, I think is there anything we're missing in this conversation that you want to talk about?
I think people are kind of somewhat intimidated if they've never built before.
Yep.
To your point, when we started, when you purchase a turnkey ready home, you just walk in, you just go to your mortgage officer and you work with one person.
Yep.
Whereas when you build, it's different than what you're used to.
Yep.
And there's multiple people involved. You're picking your builder, you're picking your bank, you're picking your permanent financing institution. There's multiple different decisions to be made on who you're going to work with. And then it's getting all of them to work together in unison to take the project from start to finish. But I think once they get in it and they understand what to expect, that really helps them a lot, because they don't know, because they haven't experienced it. Just like anything else in life, if you haven't experienced it, you're a little bit unsure of it until you get into the weeds and learn a little bit about it.
Yeah. Thanks for stopping in.
Thanks for having me on.
Yeah. Again, this is Cody Schaaf with Nebraska Realty, representing Richland Homes and Pinecrest Homes. Mark Krings with Union Bank and Trust. If you're looking to get some construction financing, give the guy a call. And if you have any comments or questions, please leave them below, and we'll try and get those answered for you.